I'm going to get us started. Welcome, guys, to our webinar with Tom Howell. For those of you who don't know Tom, Tom is a tax advisor. He's also an enrolled agent. I'm going to have him explain. And he's a friend of mine. I've known Tom for many years through the REAPS Association. If you don't know REAPS, it's the Real Estate Association of Puget Sound. It's run by Angelique Tinney, who, by the way, is going to be one of our guest speakers in our upcoming webinar. And if you're any place near the Seattle area, or if you want to invest in the Seattle area, it's a great organization. It's actually an accredited RIA, a Real Estate Investment Association, one of the national ones. Good speakers and all of that. I knew Tom through REAPS, and then a couple of years ago, here's my introduction of you, Tom. I had a CPA maybe 4 or 5 years ago that was doing my taxes, and we had some real estate, and we have our company and all of that. And I went to him and asked him if there were some good strategies I could use to reduce my tax burden. And he scratched his head and said, "Let me think about that, John, and I'll get back to you." And then he came back to me with some stuff that I kind of knew. And so I took Tom out to breakfast one day, sometime after that, and said, "Tom, I have some real estate and I'm got the company. What should I do to reduce taxes?" And Tom pulled out his famous yellow pad and started drawing and putting little rectangles on it and says, "Here's what you need to do, John." And Tom's been doing my taxes ever since, right, Tom?
That's true. Yes, I love
Tom,
my yellow pad.
Yes, you have a couple of companies. You have the tax strategies, and you also have Revest. Can you give us a little more complete background for you, please, before we start the webinar, or as we start?
So I've been doing taxes for 30 years. I am an enrolled agent, which most people have never heard of. It's a tax certification through the federal government instead of the CPA, which is licensed through the state government. So my background was in tax representation for people who had issues with IRS. So with that, it gives me an understanding of how to argue and win with the IRS on how to take aggressive tax deductions. And so what I now do is I work with people to show them how to accurately document what they're doing, to be aggressive in what they're doing, to take advantage of all the tax loopholes that, I wouldn't say loopholes, tax strategies that the rules allow us. Real estate in particular is very favored in the tax code. One reason why you see all the uproar about Donald Trump and his tax return and how little he pays on how much he makes is primarily due to the tax code giving him all of these deductions as a real estate developer and entrepreneur. So what happens at his level can happen to the small guy. So we just bring that more complicated strategy back down to the small guy. I'm also been doing real estate investing on and off for 25 years. And in the last several years, I've been really directing my attention to building portfolios and establishing retirement income. I see so many people just letting wealth pass them by, thinking that somehow they'll win the lottery at 65 and be set for life. But if you don't be proactive and you don't give it time, it's very hard to get there. And when you start at 60 or 55, you have to take higher risks than you should. So I really want to encourage the 30 and 40-year-olds to take retirement seriously. I think real estate is far and away the best asset for that, but they need to take retirement seriously and start to build a net worth and a cash flow that serves them later in life.
Very good. Good introduction. So let me do a little bit of housekeeping, guys, and then we'll get Tom started on his presentation. We're going to do future webinars. You're going to see the next one is coming up is going to be January 27th. It's going to be with Angelique Tinney. Angelique is the president of the REAPS organization. That is my cheering section in the background there, which we'll try to get rid of in a second here. Sorry about that, guys. The webinar after that is going to be February 8th. We had the credit repair scheduled, and I got real sick before Christmas, so they weren't able to do it. So we're going to move them into the February 8th timeframe, and you'll be able to see and hear them then. And then we have a bunch more coming, which we can let you know. I do want to let you know, the guys who are on the webinar right now, if you have any questions, click on the chat function, and you can put your questions in there. I will pause Tom occasionally while he's doing a presentation if there's a question that's really appropriate for that particular moment. Otherwise, I'm going to hold off on the questions. We'll have some time for him to answer those at the end. And Tom, I have one question for you before you get going on your presentation. It's after January 1st now. Is there still time for self-employed borrowers, real estate investors to do something now prior to filing their tax return for 2022 that can impact the taxes they paid back in 2022?
So there are some things. Really, the only thing that we can do is fund an IRA after the fact. 401ks and things like that need to be processed before December 31st. If you bought some assets in 2022, we can be flexible in how aggressive we are in writing off the depreciation, the cost segregation, and some things like that. So if they need the deduction and they're able to take it, we could do a cost segregation study. If it's not going to make much difference because of some other things on the tax return, then we wouldn't go to that expense and we would just do standard depreciation.
All right. I know you're going to get into that in depth. So without further ado, Tom, go ahead and bring up your PowerPoint presentation and take over.
So
let us know.
I have not used Teams before, so tell me how I share my screen.
There is a button on the top right that says share with a little up arrow. Do you see that there?
I do. And does that work? Can you see it?
We can see it, Tom.
Okay. So tax planning for real estate investors. This also applies to self-employed borrowers. What I like to say is it's what you keep that counts. That's my little tagline. And so many people pay more money to the government than they need to. So my mouse is not advancing my slides. Why not? There we go.
Yep, you see the second one now, Tom.
Okay, so one of the secrets we have to beating the IRS is to have a tax plan. There's been multiple cases where the IRS has challenged taxpayers for plotting a way around paying taxes. And the Supreme Court has said that there's nothing illegal about being proactive and operating within the tax code to reduce your taxes. There's no obligation to pay more than you really owe. But it takes a plan. It takes a strategy of what to buy, when to buy, how to fund. Running an active business is different than running a passive income business. And so we have a myriad of things that we can do, but a lot of it depends on each individual's income level and where their income is coming from, be it a job or a business or passive income. So real estate, which is my great love, is the last great easy tax shelter. There's a lot of other tax shelter opportunities, but some of them take a lot of work to get into and to manage. Real estate is everywhere. Everybody has to have a place to live. So I'm an advocate of using real estate to shelter taxes. Let me tell you why rental real estate is so good and why it makes money. One, we all know that it creates cash flow. There's somebody paying rent usually. Land is a separate idea, but cash flowing from tenants is a great thing. You have cash coming in. You buy a stock, a growth stock, and there's no dividends. There's no money. You just sit and wait for it one day to be worth more money. Real estate gives us that cash flow. Over time, if we have an amortized loan, we're paying down the principal over time. So we're actually gaining equity with every monthly payment that we make. The IRS lets us take a deduction for all of those out-of-pocket costs against that income. And then the real one that is good for us is depreciation. Even though the house might be going up in value, the IRS conceptually believes that the house is wearing out over time, and they let you take a deduction for your cost of that property. In addition to that, we know our property is going to go up over time. And of course, there's always a year where it's flat and level and you're not seeing much happen. But over time in the Seattle market, it's 5.6% over the last 50 years. It's almost 4% nationwide over the last 50 years. So real estate generally marches up and up and up and up. And we have an advantage of taking a reduced tax when we sell. So if we have a high enough income that we're in the 30-35% tax bracket, and we sell a piece of property and make $250,000, we generally only have to pay the capital gains rate or the recapture rate against that. So we might make this big chunk of money, but we're paying lesser taxes on it than we would if it was self-employment income.
And Tom, or you may touch on this, what is the capital gains rate at a time like that?
Well, it's complicated. Generally, it's 15%. It can go to 20%. Plus, there's a surcharge of 3.5% if it's too high and your other income is too high. So it could stack up and be 20, 25%. But generally, for most people on smaller gains, it'll be 15%. And here's why real estate is a great investment and better than what I see in the stock market. I used to be a securities licensed individual, thought I would do financial planning for my clients. I found out that the industry is not everything I thought it would be. And when I promoted real estate as an investment, I actually got in some hot water with my brokerage because I'm selling away and giving advice that the house can't win with. So they told me not to promote real estate in my webinars when I'm licensed, even though I firmly believe in it. But here's why real estate makes such a great investment. It's low risk. The fluctuations in value are generally very slow. We just saw this last year where the stock market can drop 5, 10, and 15% in a matter of days. Real estate, we may have lost 10% over the last year, but it happened over many, many months. And if we had a panic situation, we could have sold without getting to the bottom. And over time, real estate generally moves up, also kind of slow and cyclical. We have control. When you buy Microsoft, you don't have much say in what Microsoft does. If you buy Tesla, you can't control Elon Musk. He's going to do what he does. But when you buy a house, you can choose where to buy, who you're going to rent to, what you're going to do to add value to that property. And we already talked about the cash flow, so you get this monthly income from it. I don't know how to respond to that. My watch is talking to me. When you buy a stock portfolio that produces dividends, it generally is in the 4% cash on cash return that you can get. But real estate done right can be 6, 8, 10% in some markets, cash on cash return. So you can certainly beat a stock portfolio for income in retirement. It also gives us the advantage of leverage. You could buy Microsoft stock, go get a margin loan and buy more stock. It's a little bit of a dangerous strategy, but leverage in real estate is common. Banks everywhere lend on it, and the leverage is what gives us the wow factor in the return. Again, we have appreciation. So I told you 5.6% in Seattle, and the national average is almost 4%. And the tax savings. We get to take the losses every year. Even if we made money every month, we may have tax losses that we can take every year, particularly in that first year when we choose to do cost segregation. Some of the deductions that we get to take against real estate include the mortgage interest, the real estate taxes, any supplies that we use, if we pay homeowners dues, if we have repairs and maintenance to the property, our management fee, our advertising, all the things that we pay to conduct our real estate business is deductible against that income. It has to be ordinary and necessary. So you can't, put gold-plated toilets in a Section 8 house and write it off. I'm sure the IRS would challenge that. It's not ordinary and necessary. And they must be reasonable. A lot of people want to take some real aggressive deductions. Someone just told me the other day that because they're a real estate agent, they want to be able to deduct their hair and nails. And the IRS has pretty much said no to that. It's not ordinary and necessary for the production of income. If you were a hand model, it might be something that we could then argue is necessary for your income, that you have to pay for that. The big wow in real estate, though, is depreciation. And the IRS has this concept that the house will wear out over time. So they've told us that single-family homes they'll be worthless in 27 and a half years. So they let us take one slice every year of that house wearing out. On non-residential buildings, it's 39 years. And the real advantage that we have today is the personal property can be 5 or 7 years. And one of the reasons that works for us is we do a cost segregation study, which had usually only been done on very large buildings. The studies were $5,000, $10,000, $15,000 to do a cost segregation study. There are now cost segregation studies that you can get for $600, $700, and $800 on single-family homes. That can give you almost 15 or 20% of the purchase price of the property as an instant deduction. So you buy a $500,000 property and do a cost segregation study, And you may very well have $60,000, $80,000, $100,000 in deductions you can write off that first year. If you're in the 20% tax bracket, that's $10,000 or $12,000 real money that you saved in your pocket. The way that works, we have our rental property, we break out the land, we break out the improvements, and then we depreciate the land improvements and the building. But what gives us a lot up front is that personal property at 5 or 7 year depreciation. So we shorten it up. And in the last few years, we've had this concept of bonus depreciation. Let's just take all that 100,000 at once, or 80% of it now this year, all at once. So depreciation is really what makes real estate a tax savings vehicle. We talk about the personal property in the property, and we have a cost segregation study that breaks out those values. And some of the things that we break out include things like cabinets, the countertops, the flooring, the appliances, if you have a security system installed, if you have non-structural walls that are not necessary for the building to stay standing, if you have window treatments, blinds, and drapes and so forth. We can take all of those costs and say we're going to take 80% of that all in the first year. Huge tax savings, instant cash dollars in our pocket from the purchase of a piece of real estate. A common question we have is repairs versus improvements, and when can we take one over the other? If we have a repair, we get to take it all at once. If we do an improvement to a property, we have to depreciate it over time. Repairs are considered things that keep the property in good condition. It does not necessarily prolong the use of the property. It can include paint, repairing windows, fixing the gutters, fixing leaks, or doing a partial roof repair. However, an improvement is not deductible all at once. It generally would add value. You put a new roof on the house, you should be able to add some thousands of dollars to the sale price if you were selling it right away. It adds to the useful life of the property, and that can include the room addition, landscaping, replacing the entire roof, or putting in all new appliances. So there's a little bit of gray area in the middle that we can move back and forth on some items. And so depending on the need for deductions on the tax return, we may choose to take a more aggressive stance on what's a repair versus an improvement. We also have to face an issue of investors versus dealers. Dealers generally are people that do transactional type real estate. The flippers of the world, the wholesalers, are dealers. They buy with the intent to sell within a very short time. They do not get to take depreciation. Their real estate is considered inventory, not investment. So with that, they have to pay additional taxes on their profit, the self-employment tax, and they're not eligible for the great things like the 1031 exchange. Whereas investors, they get to create that income over time. They get to take the depreciation, the low tax rates, and if necessary, a 1031 exchange into a new asset. So we want to make sure, yes.
Can I ask you a question around this one?
Yeah.
Let's say you're a real estate investor and you buy and hold properties typically, but you flip one a year, and you buy a couple properties and you keep two of them, and then you buy one as a flip and you flip it, and then you do kind of the same pattern of that next year. What are you then, an investor or a dealer? What does the IRS look like on that?
So the IRS will generally do a transaction by transaction look. So if they can show that you had an intent to buy the property with the idea that you would flip it, you become a dealer on that transaction. If you do, if you buy 10 houses as investment and you bought one, and after you got into it, you decided this is too much, I'm going to flip it, we could argue that that was an exception to the rule and you're not a dealer. But for most people that I work with, they are both an investor with a schedule, with an LLC coming in on a Schedule E. And then I also recommend that they have an S Corp for flipping and wholesaling so that we can take advantage of some of the rules with that entity.
Of course. Okay. So it doesn't bleed over. If they call you a dealer one property, that doesn't impact the other properties that you're an investor on.
No, but if you don't intend to be a dealer and they take you as a dealer, then all of our tax planning kind of blew up. So we want to know in advance whether we're a dealer or an investor. And I think you should be both and have two different entities for holding those.
Got it.
There are some great advantages to having an S Corp and moving money into it. So we can take things like fringe benefits and retirement deductions. So the S Corp is a great thing to do. So for those who are eligible, it lets you take some of those deductions that you can't otherwise take against your rental properties. Another big thing that I talk to my clients about is always car and truck expenses. When you look at what AAA said it really costs to run a vehicle, and most of us now have a little bigger vehicle, we might have a four-wheel drive SUV or a pickup or so on, you can see that the cost to operate those cars is pretty pricey. And the IRS is giving us 58.5 cents the first half of 2022 and 62.5 cents. So I would like to see my clients keep their records and do actual expenses. Keep an envelope in the car, shove all your receipts in there. You can get apps on your phone that track your business miles versus personal miles. But the actual cost method of that of the auto expenses is going to give us a bigger deduction. One misconception a lot of people have is they think if they just take the mileage method, they don't have to keep records. But in all cases, the IRS expects you to keep a mileage log of all your trips, the purpose of the trips, the start and stopping mileage. So the apps help us get a lot of that data captured up.
All right, and to clarify on that, Tom, because this is a really good one. You need both the calendar and keeping track on the trips and where you went, and the receipts to tie in with that. Is that correct?
If you take actual expenses, you need the receipts. I'm encouraging you to take actual expenses because it's a larger deduction. I think it's as simple as sticking an envelope next to your seat and sticking your receipts in there, and every month or quarter, pull them out, put a new envelope in, and have the receipts. It takes you an hour to add them up at the end of the year.
What receipts in particular do you want in the envelope?
Oil changes, fuel.
Anything related to the car.
Anything, the insurance, the tabs, the oil changes, all of that needs to be stuck in that envelope so you can then add it up at the end of the year.
Okay.
So we can default to the mileage method, but it's not going to give us as big a wow because the IRS numbers are less than reality. So one of the things that people don't understand is we can create some deductions to our business and still keep the money. I talk about my pair of pants, and if I move money from one pocket to the other, it's still in my pants and I'm not having to pay tax with my money, leaving the pants. One of the things we can do, if you have the situation where you have kids who are better than 7 years old and under 18, you can pay them for your business. They should really do work. You should have a timesheet. You should do a real paycheck. But you can take a deduction on your business for what you pay them, and they don't have to pay taxes on the money on their end. So the first $13,850 for 2022 is tax-free. And you can give them another $5,000 to put into an IRA. So you could pay your kid near $20,000 and you get the full deduction of the 20, and the kids don't have to pay any tax.
That's great.
Another one that we don't see too often anymore, but this was a big deal 15 years ago, was a medical expense reimbursement plan. If you have a C Corp or you have a common law employment, you can create a medical reimbursement plan where anything you pay out of pocket, the company will reimburse you for, and the company gets to take the deduction. So medical expenses today are very hard to take. You'd have to have some kind of a catastrophe without insurance to really get enough medical expenses to be deductible. This lets us take all the small stuff, including our deductible. So we could be $3,000, $4,000, $5,000 out of pocket for some medical. We get to deduct it all with this plan. This is not available to S Corps. So
okay.
So not everybody can take this unless they're wanting to set up a C Corp. But there's some reasons why to set up a C Corp to do things like this, and make that money go into the C Corp and then drain it away with deductions. The C Corp pays no tax.
All right. So Tom, before we leave here, can you define common law employment for me, please? So
common law employment is not an S Corp owner and not a sole proprietor. So you have to actually be hiring someone and paying them a paycheck.
Okay.
And not be in an S Corp.
Very good. Yeah. Yep.
So that leads us into entity planning. And this is a big part of what I do with a lot of people is which entity do they need and why, and should they have multiple entities? And depending on how complicated your world is, you should have multiple entities for both liability protection, which your attorneys want to have that for you, but also from a tax advantage. There's rules for C corps and S corps and sole proprietors and employees, and they're different. And if we can get you into one of those categories, we have the advantage of taking all the deductions available to all of those entities. So I always work with my clients to find out how much income they're going to earn. I don't want you to spend $1,000 setting up an entity and paying for a tax return if it's only going to save you $200. But if we can save you $10,000 in taxes, then it's worth spending the $1,000. For most of my clients, the LLC is always the best. And if you have an active business, I would want you to become an S Corp. That gives us the lowest tax deductions or the lowest tax liability of all. So part of it is you have to have payroll. Most people who have an S Corp that makes a significant profit need to be paying themselves a reasonable salary. That is one of the IRS requirements for an S Corp. A lot of people don't do that, and the IRS is going to get a little picky about that here in the coming years. So the other thing is to fund a retirement plan. So one of the big things that I'm an advocate of is putting money somewhere where we can take the deduction and we still have the money. And having our own 401k gives us that ability to move a lot of money into the 401k. And then we have control of the 401k, so we can now invest as we choose. So you could do real estate, you could do lending, you could do stocks, you could do crypto, you could do gold and silver. All of that can be done inside of a 401k if you control it. So I like to set my clients up with a qualified retirement plan that gives them all those benefits. And there are actually lenders out there now that will lend to a 401k to buy a property. So now if you have some kind of lucrative value add long-term hold property, put it in the 401k, and a few years from now you sell it and all that profit is tax-free. And if we create a lot of passive losses in retirement, we can pull money out of the 401k and really pay no tax on it. It'll work a lot like a Roth if we set your portfolio up right.
And Tom, before you leave this slide, can you compare and contrast a Roth versus a solo 401k for buying real estate, and in particular for getting a loan on the real estate?
So IRAs of any kind have a problem with what we call UBIT, unrelated business income tax. If you use an IRA as a partner in a property in which you use debt, part of your profit is taxable. So even though your IRA may have put $100,000 into a deal, if you have a 50% mortgage, 50% of the profit back to the IRA is income taxed. 401ks do not have that problem. So the 401k is a preferred vehicle for doing that. The Roth lets you accumulate money over time, and when you pull it out after 5 years, it's tax-free to you. But I would argue that a regular 401k without the Roth provision can also be pulled out tax-free if we keep a portfolio that's showing operating losses. So did that answer your question?
That answers my question, absolutely. So strategy is very important here, knowing where you're at with your tax planning and when you plan on potentially retiring and you lessen your tax bill from the W-2 income, and most of it's coming from real estate. Then you can pull it out of your retirement plan at that time, and it makes good tax sense.
Right. A lot of people too seem to have this idea that when they retire at whatever age that is, that they're going to be out of the game and they're done. But the reality is most people have a passion for what they're doing when they get into this game, and they never leave it. So you'll see people at 60, 70, and 80 out there swinging for the fences on their real estate portfolio. And so I like that because they are able to take advantage again of all of these rules and moving all that money around and creating a legacy that goes multiple generations deep. So when they're done, their kids will inherit a nice little nest egg that should make them and their kids very happy. One of the things that we don't hear a lot about is the ability to take tax-free revenue on our house. So one example we have is if you have an S Corp and you're going to do some kind of investor meeting, or you're going to bring a group together for a one-day class or something, you could rent your house out to your S Corp and pay rent for a meeting space. You don't have to declare the income personally, but the S Corp still gets to deduct the payment. I had a client years ago who lived real close to the Puyallup Fairgrounds. And every year during the fair, they would park cars all over their yard. They made almost $15,000 parking cars for the duration of the fair. It was all tax-free because they were renting out part of their residence for 14 days or less. So they didn't have to pay any tax on that $14,000. Now, they may have had to have paid to reseed their lawn because all that parking may have killed the grass. But, you know, you have to be reasonable. You have to compare what, you know, if you went to a hotel to rent a conference room and it's only $500 a day, it's hard to charge yourself $2,000 a day. So we just want to be reasonable, but a little bit of money, you know, you save 20-25% of everything you move to your pocket without paying tax. So that's a good thing.
Well, this may be a good time to ask a question that's in the chat here. Thanks, Andre. A question, can an LLC hire and pay kids, or does it have to be a corporation?
So the problem with both an LLC and any kind of corporation is, well, so if it's a disregarded entity LLC, you could do this. To pay your kids, they have to work for you directly. So if your corporation or your S Corp pays the kids, now you have to pay Social Security and Medicare tax on those wages. There's a provision that allows those kids to get out of Social Security and Medicare, but only if they work for you as a sole proprietor. So it's easy to set up a sole proprietor business. You could charge yourself, charge your portfolio LLC a bit of a management fee into a sole proprietorship and then pay the kids out of the sole proprietorship.
All right. And can you just mentioned, I think, disregarded LLC. Is that what you called it, Tom?
A disregarded entity.
Entity. Okay.
Yeah.
Tell me what that is, please.
So a disregarded entity is an entity that in itself will not file a separate tax return. And the net result of that business flows to your personal. So you might hold a rental in an LLC as a sole owner. We don't do an LLC tax return. We instead report it as a rental property on your personal return.
All right. Got it.
Some trusts, living trusts, are also disregarded entities. So you could have a living trust. Everything is titled in the living trust, but we don't do a trust return. All that money passes to your tax return.
All right. Got it, Tom.
And then here, as I get near the end, one of the things that everybody's worried about is red flags. And I always hear, well, you know, I don't want a red flag here and I don't want a red flag there. But I'm telling you that red flags are not a problem. If you're not lying, cheating, or losing your paperwork, you can be in and out of an audit in 3-4 hours. If you are tight with your paperwork and your documentation and what's going on, audits are nothing to be worried about. Where if someone tells you don't take a deduction because it's a red flag, they're telling you it's okay to pay extra money. And I'm saying the other way, you want to take every possible deduction that the tax code gives you and be prepared to defend it and document it. Now, you can't just lose all your receipts and then say, oh, well, I have a credit card statement. They don't like that. But there is nothing wrong with being aggressive and having all the documents lined up so you're in and out in an afternoon.
So, Tom, let's do some hypotheticals around this one. Let's say you lost your receipts, but you did use that credit card. So you go back to the credit card company and you pull up last year's transactions all the way through, and it showed Home Depot for this and it showed something else for that and everything. Would that be acceptable?
It all depends a little bit on the attitude of the auditor. So the IRS says they need receipts. If you go to Costco, you could be buying food and saying it's a business expense. They want to see the receipt so they can see what you bought. So your credit card statement says you spent $150 at Costco, but nobody knows what you spent. So a company like Costco and Amazon, these companies are great because their records go back forever. So you can get a receipt from 3 years ago at Costco easily. But, you know, when you, same thing with Home Depot, they want to make sure you're not buying appliances and sticking them in your personal residence. So in an audit, they may ask those questions and want to have some validation that those new appliances went to the rental property you said they did. So we want receipts. We want conceptually, everything we do is done for a reason. If you're paying yourself a management fee, let's put a property management contract in place that says that your LLC is going to pay your S Corp 10% of the rent. Things like that. We need to be documented in what we're doing and why we're doing it.
Very, very good.
I'm not sure I understand.
Oh, my poor watch just keeps talking to me. Okay.
There's another question in the chat box, Tom. What's the best, easiest, cheapest way? I like that, Roxanne. Best, easiest, and cheapest, Tom, okay? To retitle personal properties to the LLC, does it need to be at refinancing time? Is an attorney really necessary?
So I would say no. It's as easy as a quick claim deed, which is probably $30, $40 to file it at the county. It's a one-page document. If you are the sole owner of the LLC and the sole owner of the property, there's no taxation when you move it in and out. You do have a problem if you're the sole owner of the property, but then you have a partner in the LLC. The state's going to want excise tax for half that property transferring to a new person. But it's really quite easy. I don't think you need to go to an attorney. If necessary, you might go to an escrow company, and they might charge you $150 to prepare the paperwork and file it, but it should be quick and easy. But it is important to put that property in the LLC name. If you want that shield of liability protection, the asset really needs to be in the LLC's name.
Okay.
Common banks don't generally like to lend to LLCs, but there are investor lenders that will lend to the LLC. So you may want to investigate your choices before you move that property in and out and in and out. Investigate other lending options and see if you can get a loan that works for you in the LLC.
Yeah, I mean, I will tell you guys, we have lenders that prefer LLCs to lend to. So there's a wide appetite of lending out there. And you want to be a little careful because when you change from the personal name and you quit claiming over to the LLC, you're changing the vesting there, that could potentially trigger the due on sale clause. Yeah, I will tell you in my time of doing this, I've seen many of my investors do that. And I know that because when they come back to me, I go, oh, your property's in the LLC. And they go, oh, whoops. And they take it out and put it in the personal name, and then we do the loan for them. I don't think anybody's ever had a loan called, but you want to be aware that there is potential risk there.
Right. So there's my information. So people can email me. That's my preferred way of being contacted. And we're coming into tax season here. So between now and April, I'm going to get really busy. But yeah, I love talking real estate. I could have coffee with anybody anytime and chat on real estate forever.
I can attest to that. So Joy has a question, Tom. Could you please elaborate how to include real estate into 401k portfolio? Thank you.
Okay, so there are lenders. Some of these same lenders that lend to LLCs will lend pretty high loan to values to a 401k. So the 401k, you as trustee of your own 401k can sign the purchase and sale agreement to buy a property, and the 401k would be the sole owner, and you can then get a loan on it. Here's the challenge you have. You can't manage your own properties inside of a retirement account. So both IRAs and 401ks would require that you have outside management. So you would want to pay for a property manager in that case.
Good to know. And the LTVs on those guys are probably in the 65% loan to value range. Tom may know. You haven't even know you do higher than that, Tom?
Well, Civic has told me that they would go to 75 or 80.
That's true.
But
they will.
Still sets, the income is the limiting factor around here. So
that's
it's hard
exactly
to get
right.
an 80% loan and cash flow.
Yeah, those are debt service coverage loans, which we can talk about in another webinar, guys.
Right.
But yeah, Tom's right on that.
And that for seller financing is so great. If I had 100% seller financing deal, I would buy it in my 401k all day long because there's no bank lending, and the seller doesn't take you through that same process of, what are your assets and what's your income, and can I see your tax returns?
I take it you're telling me it's difficult to get a loan through the regular bank.
No, well, I think it's difficult to get traditional lending, right? So you want a 30-year fixed rate amortized loan. It's hard to get that at the 401k without 50, 60% loan to values.
Yeah.
If you want to get to 70 and 80, or even 90, that's where seller financing is so beneficial.
Absolutely true. And different loans have different income and asset and documentation requirements. So there's a wide variety there as well. If you want the cheapest rate, you're going to be Fannie Mae, Freddie Mac. We're going to ask for all that stuff. Your bank statements, your tax returns, if you're self-employed, your W-2 statements and everything. If you want the simple loan, I call it, which is also known as the DSCR, the debt service coverage ratio loan, we don't care about much other than the income on the property. So they're much simpler and easier, but the rates are going to reflect, it's going to be higher. It's kind of how it works. Let me check here. Anybody else chat? Put your questions in there, guys, and I will read them to Tom. Tom, I have a couple things for you. You mentioned S Corp and C Corp. Can you kind of compare and contrast? What's the benefit of having an S Corp over a C Corp, and when would someone want one or the other?
So a C Corp is the traditional corp that we all think about, Fortune 500 companies and so forth. The C Corp is in itself its own entity. It pays its own tax. It has its own liabilities. You are simply an agent of the entity. The S Corp is a pass-through entity that allows us to take the profit and the loss, and whatever we have net, our net profit, we get to move to our personal tax return, and we only pay taxes once on that income. It is possible in a C Corp that you could have a profit that the C Corp pays, and then you again would pay taxes on the dividends when you take that profit out of the C Corp. However, there are deductions that are available, primarily fringe benefits, that are deductible by the C Corp that the S Corp cannot take. So it might be worth paying $10,000 in taxes on the C Corp if we're saving $25,000 by taking fringe benefit deductions. So it's a case-by-case basis of when someone should use one versus the other. Overwhelmingly, I see realtors, contractors, people like that should be in S Corps. And it's not that common to see someone who also should have a C Corp.
Okay. What kind of benefits?
Your picture froze on me, so I didn't know if you heard me or not.
I heard everything. Yep.
Okay.
What kind of benefits would make it? What's the particular client that would you think would be advantageous to have a C Corp over an S Corp?
If we wanted to write off high cost medical insurance, we could do that. If we want the medical expense reimbursement plan, I actually have a client who's paying almost $9,000 a month for chemo medicines that their insurance is not paying for. That's a person where if they had a medical expense reimbursement plan, they could turn all of that into a deduction. So for them, it's worth finding a way to move income into the C Corp. So one thing I like to do, if you have a lot of properties in an LLC portfolio, pay yourself a management fee and move it into your S Corp or your C Corp so we can use that money to fund further tax deductions that we cannot take in the portfolio.
Okay, got it. Tom, you mentioned the cost segregation being a really significant thing to do and how inexpensive that can be done now. How would someone go about getting a cost segregation done? Who do they contact if they have a property and they want to do that with?
So I actually am now signed up with a company that allows me to do properties under $1 million. So I can do a cost segregation study for someone who has a single family home of $1 million or less. If you have properties bigger than that, you have to hire a professional cost segregation company that does engineering studies, and they are going to easily be $2,000, $3,000, $4,000 and up. And if you're buying a $10 or $15 million apartment complex, you'd pay $15,000, $20,000 for that study. But again, 15% of that purchase price can be written off all in 1 year, or 80% of that 15% can be written off this year now. So it's a huge upfront way to put cash in your pocket.
Okay, got it. And Thomas, what is your ideal client? So we're going to have if it's on a YouTube channel, guys, you're going to see Tom's contact information up on the screen to reach out to him. He had it at the end of the slides as well. What's the ideal client that you should be contacting you, Tom? For what purpose and reason can you serve them best?
Well, certainly someone who's just they work at Boeing, they get a W-2 and they own their own home. That there's not a lot of work that we can do to save them money. Where my value comes in is in creating a tax plan going forward and how to create multiple businesses, multiple investments. I love real estate investors in particular. There's a lot of creativity that I can bring to your real estate transaction, and then bring a tax mindset to that creativity. So we can really get into some properties that other people just shake their heads at and go, how did you do that? So I like real estate investors, active, busy, portfolio building real estate investors.
I'm chuckling because that is so true. I know that of Tom, absolutely. Tom and I co-host a group along with Joanne Rocheford, which is the North End Reaps group. It's the second Saturday of every month. Typically, it's at 9 o'clock now. Tom, is that when we get going, or 9:30?
9:30 is when we start.
Okay, 9:30. People get there about 9. If you ever want to join us there. So the main group for Reaps that I mentioned is down in Bellevue, typically is where they meet once a month. And there are a number of satellite groups, one of which is the North End one that we co-host. And I can tell you, if you want to see Tom live, and he does a presentation there occasionally, and there's all kinds of stuff about real estate we talk about. So join us there. It'd be great.
This Saturday is our meeting. So people
This Saturday
come this Saturday to Keller Williams on Everett Mall Way.
That's right. That's where it's at. Thank you for that. If you need any more instructions or anything like that, just email me. My email is jmurphy@bayeq.com. Tom had his contact information there. Do you want to just state your phone number one more time, Tom?
Yeah, I can.
Best way to reach.
The best way to reach me is by email.
Okay.
Tom@taxstreet, as in Wall Street, taxstreet.com. And if anyone is interested, I'm putting together a video series that I'm going to be emailing out to a select list of clients. And if you wanted to be part of that list, send me an email and tell me you want to be on my video list, and I will add you to it. I just was talking to my coach this morning on how to put the final pieces of that together. So in the coming weeks, I'll be sending out informational videos.
Good. So, we look forward to seeing that.
Yeah.
We look forward to having you on a future webinar as well, Tom. I know there's lots of topics you can talk about. That's so great. So thanks for joining us today. I appreciate it very much.
No problem. Thank you.
Thank you. I don't see any other questions in the chat box, Tom. Well, thanks, guys, for joining us today. I appreciate that as well. There will be a recording of this if you want that, or if you want to send it to someone else, just reach out to me with my email. Let me know. And my cell number, it'll be on the screen later on, is 206-499-5626. Thanks, guys. Thanks, Tom.